China's collapse nears. I'm Steve Van Metre. Tariff chaos is crushing China's economy, and Beijing is scrambling as factories freeze. Panic spreading fast. You won't believe what just happened in China and why it means their economy is on the brink of collapse. Now let's head over to Bloomberg, where he picked today's story up with a headline: as Trump's tangled tariffs sow confusion as negotiators line up. And that's part of the plan, you see, to create massive amount of confusion in this trade war and force people to come to the negotiating table to make a deal. We know as soon as one deal's made, the other countries are going to fall right in line. But China's saying they want to fight here. They put up even more trade barriers and saying, look, we're done with that battle, but we know they have ammunition left to fight. They can devalue their yuan. They can stimulate their economy. But we just got some data that shows their economy's on the brink of collapse. You're not going to believe what happened there this weekend, because it's saying that China's economy is about to fall face first off an economic cliff. The dizzying weekend saw Trump exclude popular consumer electronics from 125% tariffs on China and a 10% baseline global tariff. The move exempted more than $101 billion in U.S. imports from China alone and was seen as a short-term win for U.S. tech champions like Apple and Nvidia. And this sent equity futures rallying in overnight trading as people thought that this was the beginning of a potential de-escalation between the two superpowers, only to find out from the administration this was temporary and these tariffs were likely coming back in a different form in the near future. The Trump team continues to follow an approach of act first and then make adjustments as needed to keep its trading partners off guard, to get them to come to the negotiating table and make a deal, and make one quickly before things get even worse. This approach contributes to more unpredictability for investors and our trading partners, who may no longer conclude that rushing to negotiate with the U.S. is the best approach. But it is the best approach because we all know that the United States is the world's largest importer, and a lot of economies are dependent on their imports into the United States. So even a temporary decline could plunge another economy right into a recession. And that's the goal here, is we're playing a game of economic chicken. Whose economy is the strongest? Who can withstand this? And for a lot of small economies, they have absolutely no chance to withstand these tariffs. They must come to the negotiating table, and soon. But China's government said the U.S. decision to exempt certain consumer electronics was a small step and called for abolishing tariffs altogether. President Xi Jinping is headed to Vietnam, Malaysia, and Cambodia this week to shore up relationships in the region. And there's a really good reason behind this, because yes, China can cut its exports to the U.S. in this tariff battle, but they're still dependent on the U.S. and other countries for their goods to flow. And so what China's doing is simply going to other countries, and they're going to make deals and push their goods across borders and have them ship out of those countries, which is exactly what somebody commented last week. They said, look, a lot of you don't realize that China's goods are in everything we buy all over the world. So somewhere or another, China is going to push through this right now, looking to its near partners to keep themselves alive. But we just found out that China's road traffic indicators are set to collapse as tariff war cancels factory orders, and that's the big issue. You know, when you look at this game of economic chicken, what do we see? The United States, the world's largest importer. But what is our advantage here? Well, one, our stock market is up relative to a lot of other countries. Our economy is stronger, but what's the even more important issue? We have inventory, and we have a lot of inventory on ships that's on its way here. But what is the issue when you go back to the front of this battle? Well, you find the manufacturing sector. So this is going to have an immediate impact on economies all over the world, particularly China. And what we're finding out now, based on traffic conditions, is it's hitting, and hard. U.S. media outlets have reported that U.S. companies have canceled or reduced orders for heavily tariffed goods from China, signaling a pullback in shipments likely to translate into economic pain for Chinese suppliers. And that is absolutely true. Now, for U.S. consumers, what does this mean as we head to summer months? It means there's going to be some things that they want to buy that are just not going to be available. But again, the good news is we do have lots of inventory already. But here, we talk about Chinese suppliers. When you think about the factory level, it's important to understand manufacturers run on very thin margins. They need to have their factories humming at a certain level to make a profit. And right now, what's happening? We're hearing from Amazon and Walmart. They're cutting orders. They're looking at the tariffs and saying certain things aren't even worth producing because the cost will be so high that American consumers won't pay it. And this, for China's factories, is a major problem, which is, of course, going to lead their economy right into recession. That's what we're seeing based on the traffic levels. But one thing that shouldn't be in a recession, that's your trading account. Check out this trade. We got stopped out today on our GDXJ trade. That's junior miners for our Momentum Timer Pro subscribers. They cashed in a 7.9% gain. We told them over the weekend to raise their stop loss levels due to the potential volatility of the market, because when you're up, you want to lock in. Now, if you want to get in on our next big trade, you have to hit the links in the description below. Grab your coupon code for your free 30-day free trial. Stay tuned to the end of the show for more information. Because just before Liberation Day, the traffic congestion index in major cities across China was tracking 3% lower year over year and remained below both 2024 and 2019 levels for this time of year. One can't help but wonder how congestion will be affected as Chinese suppliers face mounting pressure from canceled or reduced U.S. shipments. Now, you might think, well, 3% year over year isn't much, but for an economy the size of China's that's heavily dependent on exports, this is massive. Because when you think about congestion levels and traffic levels, when an economy is expanding, what does that mean? People are going to work, they're looking for jobs, goods are moving, services are happening, and all of a sudden, when you see a contraction, a decline in that, it means their economy is slowing. But it got worse. Bloomberg reported that China's city-level road congestion was down 6.3% in March compared to the same period last year. The next update will likely show a further slowdown, and this is something that Beijing doesn't want the world to know. They want this to be kept secret because the reality is their economy is slowing down. And if this is what happened as we go into a period where they were front-running the tariffs, what's going to happen when China's economy hits a massive air pocket, when demand plunges because factory orders are yanked, and all of a sudden they're going to see people all across trade and transportation, at the manufacturing level, at the supply level, all levels are going to face a decline in demand, and this means for workers, they're going to be sent home. They're going to see their hours cut. Jobs are going to be lost. Demand is plunging in China, and again, Beijing doesn't have a lot of response here other than hoping that things work out. And all this is happening despite the fact that China's exports skyrocketed over 12% in March as the trade war drives businesses to front-load shipments. And again, what China's economy is facing is a massive air pocket as demand plunges. They need to see consistent demand at their factory level, again, to keep everybody profitable and working and making money. And now what we're seeing in the traffic levels is it's anything but and looking to collapse even more. And the evidence that demand in China's plunging as imports fell 4.3% in March from a year earlier. Economists expected a 2% decline. Now, this is a very strong indicator of internal demand, because when you see imports go down, it means consumers are not demanding as many goods and services. It means factories are not running at levels they need to. And experts said it should only drop 2%, but it doubled that at 4.3%, indicating that China's economy is headed into further contraction here, likely to see further deflation in the consumer price level, and at the factory level, as we've noted, the producer price index remains negative. But the evidence demand is plunging in China is very clear as we take a look at consumer confidence. This is as of January. You can see where is it going to go in April and March. We can expect this is going to plunge even more because we know that U.S. consumer confidence is based on consumer finances and the labor market and the outlook for the labor market. We know Chinese consumers, it's likely the same, and what they're looking at is the same thing that we're telling you right now is the demand at the factory level is falling. Consumers there are going to see their income shrink. They're going to be facing job losses. And the worst, there's going to be no opportunity to re-enter the workforce because demand across the board is in decline. And what we're seeing is widespread booking freezes among global trade, as March 2025 bookings fell 20% from January peaks, even though volumes were still 30% higher year over year compared to 2024. The most likely explanation? Shippers moved to quickly front-load shipments ahead of anticipated tariff increases. And again, we talk about the factory level, but this is also going to impact the trade and transportation level, because you're going to find out that employers are not going to sit around and keep people on the books at full pay if there's no work for them to do. They're going to cut hours, they're going to cut jobs, and what you're going to see is a plunge in imports coming into the U.S. as a result, and we're seeing that now. And this isn't going to affect just people overseas, it's going to affect U.S. workers at the docks as well. Here you can see a massive plunge in U.S. import bookings, but look at this details. We see major week-over-week drop in ocean bookings. Global TEUs down 49%. Imports into the U.S. down 64%. Now, normally this would indicate that demand in the U.S. is plunging, but keep in mind, we've got massive amounts of inventory overhang to work through, so this is not something that I think is going to have an immediate impact on our economy. But overall U.S. exports, this will have an impact at the factory level, down 30%. Imports from China, it's down 64%. U.S. exports to China down 36%. So you can see that the U.S. economy is going to face an air pocket as well, but China is going to face it first. And that's the game here. Whose economy reigns supreme? Who falls first? I want to know from you. Do you think the U.S. comes out ahead? Or do you think China? Or do you think we both go down at the same time? Weigh in the comments below. The whole system seems designed to create paralysis. A chief executive officer of a cargo and logistics giant, DHL, said the company's trying to conform with consistently shifting U.S. directives. Don't know if even something's announced, whether 2 days later it's not changed again. And this is a problem for corporate executives that are making decisions 6, 9, and 12 months out. They don't know what to do because tariffs are changing by the day. They don't know when they're going away. And when this happens, what they're going to simply do is cut orders. They're going to just let things fall down because they don't want to actually bring in new goods, find out they're paying a big tariff, only for 2 weeks later to find out the tariff has dropped. So this is a major issue. It's going to affect trade, transportation, manufacturing, and then what you're going to see, consumers are going to get on board with this because uncertainty is going to impact them. If they see slowdowns in manufacturing, if they see slowdowns in trade and transportation, what it means is they're going to see hours being cut, they're going to see their take-home pay shrink, they're going to look at the labor market and they're going to be worried that if they lose their job, there's no other options, and that means for many American households, they're going to tighten their budget and quit spending. You really see some fatigue of decision makers in manufacturing and all across the distribution sector. I hear a lot that customers are simply saying, well, wait for now because they don't know. Why pay today if the tariffs are going to come down tomorrow and you can pay a lower price? This is an issue. Again, businesses are facing all across the board, all across the supply chain. And it's not helping because consumer confidence here in the U.S. is plunging right alongside that in China. And those who say Trump's policies are making them financially worse off increased to 49% in a CNBC April 8 to 11 poll, compared with 42% in a similar survey back in March. And while 42% they expect new tariffs to worsen the economy in the long term, 34% said it'll be a plus. Now, I want to know from you, are you expecting your finances to get worse? What do you think about the tariffs? Is this short-term pain for long-term gain? Weigh in the comments below. I'd love to hear from you. I want to know what you think about what's going on and how it's impacting you. And brace for continued extreme volatility, the top Goldman trader warns, saying that the pain in the equity markets is far from over. Trump's announcement of a 90-day pause last week on some of those tariffs led to an S&P 500 rally of 10%, the third best daily return for the S&P since 1950. But hang tight, liquidity is drying up because there's a severe lack of it, and the S&P 500's top book of depth every session is showing a further decline in liquidity. Now, if you're wondering what liquidity is are there enough buyers and sellers to meet demand? And what we're facing right now in a down market, in a period of uncertainty, is there's a severe lack of buyers. Now, if you go back and look at peaks of bull markets, what do you find out? Periods where everybody is bought in. And what have we been warning you about? That everybody that wants to buy is in. We've seen fund managers buying, retail buying, hedge funds buying, corporates buying, everybody's buying. The problem is what happens when it runs out, and that's the issue we're facing right now. This is why you're seeing stocks move in such major fashions in ways that we aren't used to, because right now there aren't enough buyers to support any form of selling. In fact, if a large seller were to come in and try to move billions of dollars, they're going to move the market in a major way, and that's called lack of liquidity. But it's also showing up in the bid-ask spreads. A widening in the bid-ask spreads for the median S&P 500 stock is another indication of today's poor liquidity environment. On the 7th, the bid-ask spread for the median S&P 500 stock jumped to 22 basis points, the highest since March of 2020. And you remember back then, we were facing a banking crisis. So what we're seeing is not only is liquidity drying up, but the expectation from Goldman is it's going to get even worse. But now we're going to turn to one of our favorite former Fed chairs, former Treasury Secretary Janet Yellen, who says not to worry. The treasuries are showing a lack of U.S. confidence, not dysfunction. Of course, we know there is dysfunction in the market because what's going on with this basis trade with hedge funds, it's the repo market. Now, the repo market is where you go to get overnight money and you get it very cheaply. But the problem is repo providers are nervous about the economy all of a sudden, and they're asking these hedge funds to post collateral because they can't afford to post collateral and make money on the trade. They've been dumping treasuries. That, Miss Yellen, is called dysfunction. That's exactly what it is. It's not a lack of confidence. Well, it's actually both. I don't think we're seeing dysfunction in the sense of liquidity completely drying up in the markets, but yet Goldman's saying that's exactly what's happening. But she goes on to say a pattern suggestive of loss of confidence in U.S. economic policy. The pattern is really very worrisome. Well, that is what happens when you see lack of confidence. It turns into dysfunction, Miss Yellen, and that's the issue we're facing here is everything right now in the U.S. economy is not looking good. The global economy isn't looking good, and people that have money all of a sudden want to hold on to it, and those who want to sell and get out of this market can't without moving it in a major way. The former Treasury chief didn't expect China to sell its holdings of treasuries, though. The nation has the second largest foreign stockpile of the U.S. of government debt, and as we've noted for the last several years, has been a net seller. China, she said, if they were to sell dollars, would be pushing up the value of their own currency and creating risks to the treasury market and to global financial stability that would harm them and would represent a very significant escalation. So it's not something I would expect China to do, and we aren't expecting that either. We think the dysfunction has everything right now to do with the repo markets. Even though China has been selling, is likely still selling, we don't think it's a reaction to the tariffs. We'll find out in the months to come. Of course, the data is very lagged here. Not even Janet Yellen knows the answer to that. But she said the risk of recession has gone way up, and indeed it has. But I wouldn't want to go so far as to forecast one for now. Keep in mind, if a former Fed chief and former Treasury Secretary ever says that there's going to be a recession, well, you can say that is the biggest red flag you could see. So for now, she's saying there isn't one, but right now the evidence suggests that we're getting very close. And if this trade war doesn't end soon, we could see a globally synchronized recession. And based on the data coming out of China alone, based on their congestion levels, tells me that China is going to be the loser in the battle between the U.S. But just because the economy is about to plunge along with the stock market doesn't mean you can't make money. Our Momentum Timer Pro subscribers locked in a sweet 7.9% gain in a matter of 10 days. We put this trade back on the open on the 10th. We told them to buy it open, and we got stopped out today after we raised our stop levels up, because as we tell our subscribers, when you're making money, you want to hold on to it. Now, what is the edge? Why are we a difference maker here when it comes to trading momentum? Well, because a lot of people trade momentum indicators like the RSI, the MACD, and the Stoch, but they look for oversold conditions as the indicator to buy. But the problem is, in a down market, something can be oversold, bounce, and then hit oversold again. But what we do, if we overlay the trend on top of that, pair it together, we call that Momentum Timer Pro. Each and every day, we look at the broad equity, bond, currency, and commodity markets, and we run momentum screens on a 1 day, 1 month, 3 month, and 6 month window to find out what's going on with momentum and the trend. And what happens is we pair that all into our reports. You get the report, the daily signals. I review all of them and give you my opinions on the best trades to take. I give you risk control levels, a full tracking of all our open trades to return, a weekly update. And here's the best part. You don't even have to put a dime out to try it. That's right. We're so confident you can make money trading just like our subscribers did last week that we want your first 30 days to be on me. Use the links in the description below. Grab that coupon code for your free 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.